Kishore, Manu, and Dia. So Manu
Yes,
and
sir.
yeah, Kishore and Dia. So all the three are there. Good. So Kishore, आपने कुछ करा उसके बाद? I mean, those predicted P and all. I mean, you have gone through that concept.
Yes, sir. I have gone through that. देखा मैंने सर वो आपने जो स्लाइड भी भेजा है.
अच्छा, अच्छा, चलो. Because in your IPO analysis, if possible, I mean, you have to just the one question is what is predicted P and how it is calculated. That's all. Whether you will do the calculation or not doesn't matter. But if you can do it, it will be good. Okay. ठीक है. Go ahead,
Sir,
please. Yeah.
you have asked predicted P for IPO valuation, but for a single IPO, but we need many data for prediction of
You
P.
require
No?
at least at least 15, 20 companies against which you can calculate the so your data set should be big enough, so that would be the only the issue basically. So you have to see that
Yes.
there's what a lot of
And if
competition.
like my company is from insurance sector, I do not have that much of companies within the
So
insurance.
don't do that. So don't you're not required, but you have to just mention that what does it mean and how it helps you to analyze basically that how the company
Sure,
is
sir.
valued or another. That's all. Just say something about
Okay.
that. That's all.
Okay. Thank you, sir.
So please go ahead.
Because I'm presenting the screen now.
Okay. So आपका टॉपिक क्या है?
Uh, so, so sir, we have made our topic actually. I think all the groups are presenting the same mutual fund only. So
Okay.
we have decided. So we have decided to pick two topics.
Okay.
So within mutual fund, we will explain only the flexi cap fund
Okay.
in detail within mutual fund because the earlier group has also talked about nearly everything about mutual fund. So in the mutual fund, we will talk about the flexi cap fund and other things. In the options, we will talk about the bear call and bear put strategy.
Okay. Good.
Okay. So sir, we'll start with the mutual fund presentation, and the mutual fund presentation will be headed by Dia and Manu, and then I'll take over with the options part.
Okay. Good.
So good afternoon everyone. Today I will be talking about mutual funds, a comprehensive guide, and my with my partner Manu. So moving forward to next slide. So introduction to mutual funds. A mutual fund is a pool of money managed by a professional fund manager. It is a trust that collects money from a number of investors and invests the same in equities, bonds, money market instruments, and the income gains generated from this collective investment is distributed proportionally amongst the investors after deducting applicable expenses and levies by calculating a scheme's net asset value. Next slide. Majorly today we will be talking about FlexiCap Fund. So the FlexiCap Fund is an actively managed firm aimed to outperform the market by selecting individual stocks or bond that the fund manager believes will generate superior returns. So FlexiCap funds can invest in companies across all market capitalization and sectors. The primary investment objective of the fund is to generate consistent returns by investing in a portfolio of large cap, mid cap, and small cap companies. The advantages of flexicap funds are exposure to stock of all sizes and sectors, driving the Indian economy forward. Secondly, it is ideal for long-term goals that are more than 7 years away. And lastly, fund managers have the flexibility to change portfolios in the line with market dynamics. And the FlexiCap fund scheme is compared with the benchmark Nifty 500 TRI, Total Return Index. Next. So within FlexiCap fund, we have chosen Quant FlexiCap fund, which is the highest, which is giving the highest returns generated over the years. So Conti FlexiCap Fund Direct Growth is a FlexiCap mutual fund scheme from Quant Mutual Fund. This fund was launched in 2013 and it has the growth assets of 3,540 crores. The fund has an expense ratio of 0.77%. So the expense ratio is the expenses to manage your portfolio deducted from your assets, which is close to what most other flexicap funds charge. So Quanti FlexCap Fund Direct Growth Scheme's ability to deliver returns consistently is higher than most funds of its category, and we will look at in the Excel sheet. And its ability to control losses is a falling market is high. The fund has majority of its money invested in energy, financial, healthcare, metals and mining construction sectors. It has taken less exposure in energy and compared to other funds in this category. The fund's top five holdings are Reliance Industries, RBI, Adani Power, Housing and Urban Development and Geo Financial Services. Moving to next slide. So this quant mutual fund scheme portfolio aggregates of large market capitalization stocks of so this fund has 44.19% holding, whereas the category of this mutual fund holds 62.16%, whereas in the middle cap stocks it has this fund has 17.60 versus the category 19.65, and similarly the small cap percentage stock has 38.2 fund and the category holds 18.19 percentage of stocks. And the sector allocation versus category, so the quant mutual fund has 22% invested in energy, where this category flexicap category has only 7 to 8%. And
Okay, Dia, just stop. I mean, it's a very good slide what you have made, and so far you're making a very good presentation. I like, the data which you are presenting. But if
thank
you
you.
look at, this fund is what, quant or what?
Sorry sir.
This fund is quant fund, is it?
Yes sir, the
So,
quant.
yeah, quant has, like outperformed all other funds. By looking at this slide, what do you find, how quant is able to beat all other funds by looking at this slide itself?
So because of diversification of in a large cap, middle cap and small cap, so the flexi cap, the name itself suggests that it can invest in flexible, it has flexibility to invest in all
Okay,
sectors and
agree,
all
agree,
capitalization
agree. But
stocks.
there is one more thing, if Manu or Kishore, you can just look at this slide. Tell me by
Yes, sir.
looking at the portfolio, just looking at the portfolio, what do you infer, Manu?
Sir, it's
So we can
Huh?
so we can
yes.
say that Kishore.
Continue, Manu, continue.
So they have a large portion of their investment is in small caps, which are usually more risky, but they also give a better return than
Wonderful,
large
wonderful.
cap and mid cap.
That is what, Dia, actually, that is a point because they have put more money, as what Manu is saying, they have put, majority of the money in small caps.
The small cap.
And, in the last presentation, somebody said they have made 73% return, like quant, okay, in the 1 year
Yes.
period. So, small caps funds have performed very well in the last 1 year. So, that is reflecting into the quant's performance. Okay. Chalo, theek hai, go ahead. But you've done a good job so far. But anyway, this you should also keep in mind why the fund is performing because it is compared to the category average, it is invested more in, if you look at the small cap, this fund has invested 38% compared to the category of 18%. Okay. So that is, there lies the answer that it has done better because of that. Okay.
Okay sir.
They are riskier, but nowadays, because in 1 year, everything is performing. So in bad times, it will not perform so much, in the times when the markets are doing, not doing so well. So it may, underperform. Anyway, so go ahead, please.
Okay, so moving to next slide. Can we go to Excel before Manu presents? So, sir, this is the return file where we have categorized all over the years return of this FlexiCap fund. So we can see that in 10 years, Quant Mutual Fund has performed Scroll it down. That's it. So we can see that the Quant Mutual Flexi Cap Fund has generated 63.8% returns in 1 year, and if we compare it to the benchmark of Nifty 500 TRI, it has generated 39.98. And if we go to 2 year, show 2 year. Still it has generated the better returns from the benchmark, and we can see it over the 5 years as well. So we can conclude that this fund has outperformed its benchmark as well as the other funds. So now Manu can take over.
Okay, good. I mean, your part is over, Divya?
Yes, sir.
Okay, wonderful job. Uh, I mean,
Thank you, sir.
you have learned a lot basically, I mean, in a very short period of time. Good.
Thank you, sir.
So moving on to the risks. So first we'll talk about the general risk of a mutual fund, and then we'll move on to the risk ratios. So there are basically four kinds of risks that a mutual fund usually faces.
इसको
The
स्लाइड्स
first
पर मत
risk is
दिखाओ, स्लाइड शो में रखो.
market risk. So we've heard the phrase
Just
that
a sec, okay. हाँ, आदिति. ठीक है, मैं कर देता हूँ, ठीक है. Okay, okay, thank you. Yeah, sorry, go ahead, please.
so the first risk that a mutual fund usually faces is the market risk. So we've heard the phrase that mutual funds are subjected to market risk. This is true for all kinds of mutual funds. Even the flexi-cap fund is prone to market risk. Market risk includes like risk of recession, inflation, and things like that. It can lead to losses for investors and reduction in the net asset value of the mutual fund. The second type of risk is a liquidity risk. It refers to that difficulty to redeem an investment without incurring a loss. So usually in ELSS schemes, we see that there is a lock-in period where you cannot easily redeem your funds. So those kind of schemes are usually face liquidity risk. The FlexiCap fund is a pretty liquid fund. It doesn't. The liquidity risk for that is pretty low.
But Manu, इसमें मेरा एक point है, like ELSS schemes, there is a lock-in period. Okay, fine. So because they offer income tax benefit. So, but these funds don't have liquidity risk once they are open for, saying redemption. Because it will all depend upon individual investors. So some people have already completed 3 years. So of course, definitely, आपका point कुछ हद तक ठीक भी है, because many of the people will not be able to sell because they are still in a lock-in period. But of course, here you have to redeem your funds. Okay, so that means you just go to the fund house. Okay, so as such liquidity problem होती नहीं है in case of mutual funds. It is only applicable to stocks basically. Stocks which are illiquid, where they are not frequently traded. Okay, so funds liquidity risk is very less. Okay,
Okay.
तो
Yes,
इसमें
sir.
कोई लिक्विडिटी रिस्क अप्लाई नहीं होता है फंड्स में. ओके.
So another kind of risk that mutual funds face is the credit risk. That means that the issuer of the scheme is unable to pay what was promised interest. This risk is usually involved in debt funds, uh, where they promise an interest rate and are unable to pay that. Since the FlexiCap fund is an equity fund, there is almost no credit risk. Interest rate risk is also similar. As the interest rate in the market changes, the value of the funds declines. As let's say you have invested 100 rupees at 5% of interest for some amount of years, and then for some reason the interest rate rises to 6%. But now since you're already invested at 5%, you cannot redeem your amount. So this is also typically faced with debt funds. FlexiCap funds are usually free of interest rate risk. So moving on to the risk ratios, these ratios help us to understand the risk-adjusted return of a fund. So the Sharpe ratio, for example, is calculated as the expected return minus the risk-free rate. So which means that how much the fund is giving a return above the risk-free rate, which is the rate of the GSEC bond. So it is divided by standard deviation. So standard deviation is a measure of overall risk. So through this ratio, we can understand what per unit the return the fund is giving per unit of risk. The uh, Jensen's alpha captures the excess return a fund has delivered over the benchmark. So a positive alpha indicates that the fund has outperformed the benchmark. So for the flexicap funds, the benchmark is the Nifty 500 index. The fund that we have selected, Quant, has also outperformed the benchmark. Negative Jensen alpha indicate that the portfolio has underperformed compared to the benchmark. So let's say that if a fund has a Jensen alpha of 5, that means it has outperformed the benchmark by 5%. Tenor ratio is similar to the Sharpe ratio. It also measures the return per unit of risk, but it rather than using the standard deviation, it uses a portfolio beta, since the standard deviation is a measure of overall risk and beta is a measure of market risk. When we invest in a portfolio, the company specific risk is usually eliminated. So this tenor ratio is kind of a better measure to see the risk adjusted return of a fund.
Okay, good, very good.
So moving on to the Excel. So if we see here, based on the Sharpe ratio, can you, okay, sure, can you just give me the access to, I'll just present my screen.
Okay. Is that possible?
नहीं, I'll present by myself.
मैं बंद कर दूं.
या आप बंद कर दो, मनु अपना स्क्रीन खोल लेगा.
Okay.
Is it visible?
Yes.
It's coming.
Okay, so if we see here, based on the Sharpe ratio, we can see that the highest risk-adjusted return is given by Quant FlexiCap Fund, followed by SDFC FlexiCap Fund. This means that although the beta of Quant, although the standard deviation of FlexiCap Fund is quite high, which means the overall risk is quite high, it has still managed to give a better return over its risk. If we look at the Jensen's alpha, it is also the highest in Jensen's alpha, which means that it is promising a return of 12% over the benchmark, that is the Nifty 500 index.
Okay.
So this tells us that the fund manager's ability to pick stocks, since we saw that the fund manager has put more money in small cap funds. That's why the return has been over and above way over and above the benchmarks.
Okay.
If we look at the Trenor ratio, so the Trenor ratio measures the risk based on the beta, which is the market risk. Here also we can see that Quant FlexiCap Fund is the highest in its category, and it has given the best risk-adjusted return. Even though the beta is quite high, when the risk is quite high, the return is also high. So that concludes. Just a second. That concludes the mutual fund part that we were going to present. Now Kishore will take over.
Okay, good. So good job done, all of you, both Manu and Dea. So now Kishore is going to present. Okay. So was it a good learning for all of you, Manu and Dea, about the mutual funds?
Yes.
Yes, sir.
Okay, good. You also studied for the first time, isn't it, about the mutual funds?
Yes, sir.
Yes, sir.
Good.
So my screen is visible?
हाँ, बस अब आप उसको दिखाइए. हाँ, आ गया.
Okay. So now I'll talk about two of the strategies that an option trader generally uses. So I'll talk about a bull call spread strategy and bear put spread strategy. So here, let's talk first about the bull call split strategy. So I have taken the example of HDFC Bank, and the spot price I have taken is of yesterday's spot price. Yesterday the
So,
market closed.
Kishore, you are presenting out of the league. I mean, of course, you've chosen a topic which no other would, like to choose, because the options are, always very difficult to explain at times. So it's a good, I mean, initiative. So you get bonus points for that. Okay.
Okay, thank you. So I have chosen HDFC Bank. So the this is the spot price 1430.75, and this is the spot price of yesterday's market closed. So this is 1st March 2024 price. Now we'll take the example of call option which has the expiry at 28th March 2024. So at the end of this month. So this is the basic information. So now we have two legs. Because this is a bull call spread strategy, so there in this strategy, what is the basic motive is we need to minimize the risk. We actually minimize the risk, one by buying a call, and second leg we write a call option. So by choosing these two legs, we'll see how does the risk mitigates or how does the risk divides. So I have taken example of number of lots. I have taken 10, and the lot size for HDFC Bank is 550. So if you want to place an order, so you need to place an order of at least one lot, and one lot consists of 550 units. So so total units is 5,500. So first of all, in a buying call option, in the leg one, I will buy a call option, and my strike price, I have chosen a strike price of 1470.
Okay.
So this is a close to money trade, and the premium that has been charged for this particular call option is 20.85. So just for a basic understand of everyone, so now what basically I have done is, now I have the right after the expiry, means within the expiry date, I have the right to buy at this strike price 1470. So I have the right to buy at this strike price, which is 1470. So obviously I would like I would like the spot price to be way above 1470, so that I can minimize the difference, so that I can pocket that difference,
Achha,
which
there
would
is
be my
one
gain.
thing I'd like to ask you that do you have to, this is what option, call option on HDFC, isn't it?
Yes, sir.
So if you don't exercise your this thing, okay, I just I mean keep explaining. Of course, now there is a physical delivery, kind of provision which has come to in the stock market, particularly with regard to stock. So I was just referring to that. Anyway, so go ahead, please. So before
Okay.
expiry, you have to actually exercise your call. Okay, fine.
Yes, sir. Before the expiry, I need to exercise the call, or else it would be squared off.
But since you have already, what you have done is that you have actually bought a call and written a call at the same time or with the same
Mhm.
strike price. Okay, so I believe that your position. Okay, yeah, go ahead. Sorry, I don't
No,
know.
sir. I have write a call at a different price, which is 1510,
Strike
and
price is different. Okay, okay.
this is the strike price is different, and this is the out of the money.
Out of the money. Okay, okay. So these calls will
So
remain, till open till the time of expiry. I mean, so you have to close them basically. Okay.
yes, sir. So for buying a call, I have paid a premium of 20.85, which totals is 1,14,675. And at the same time, I have write a call option, and my strike price here I have chosen is 1510. So here I have got the premium 64,075. So we can see the net premium is 2,600. And so these are the two rows: bull call spread and naked call. Had it been I have not bought a I have not write a call. So this is the situation over there,
Okay.
and this is the situation where I am applying the strategy.
Okay.
So the net premium paid in this case is 50,600, because this is the difference between these two. So the gain in this case, so what could be the gain for me? Because my strike price buying the call option strike price is 1470, and writing the call option strike price is 1570. So this is the difference of 40. And if I get this gain, then my total premium would be this. This would be my total gain.
Yeah, total gain. Yeah.
5,500 into 40. So this would be my total gain in both the cases.
Okay.
Now I'll calculate the net gain. My net gain in the strategy, in the bull call spread strategy would be 1,69,400 because my net premium paid in this strategy is obviously less. However, in the naked call, my net gain would be lesser than this because here I don't have the luxury of writing the call option. So, so this is the net gain. So now maximum loss what I can incur in the bull call spread strategy is 50,600. So whatever is the situation, by my maximum loss is capped at 50,600 in bull call spread, but in the naked call, my maximum loss could go till 1,14,675. So this is the basic thing. Now, if we talk about the break-even point, so my break-even point for naked call is this much, 1470, and the extra premium that I have paid. But in the bull call spread, my break-even is 1479.2. So this is the formula that we can apply and find the break-even point.
Okay. So the
Now I'll
break-even point has actually shifted to from 1490 to 1479. That is basically the strike price and net premium. Okay. So you have a better strike price. Okay, at where you will break even. Okay, fine.
yes, sir. So now I have 3 to 4 cases. So I'll just explain this. Let's see the case one. If my spot price is 1540, so my strike price is 1470 and call option is 1510. Obviously, I will also exercise the option and the call option buyer will also exercise the option. So this is call option buyer will also exercise the option. So I have a profit of 2,70,000 and the call option buyer will also because call option buyer will exercise the option, I will have a loss of 1 lakh rupees here.
Okay.
So my net gain would be this.
Okay.
And I have adjusted the premium part also here because the premium that I have paid. So this is the adjusted price after premium.
Okay. Just
So
share
this,
the Excel sheet also with me on the WhatsApp group so that I can just go through. Okay.
sure, sir, I will share this. In the second case, what if the spot price is less than 1470? So if the spot price is less than 1470, then of course I will not exercise my call option. So what would be my loss? It would be loss of premium that I have paid because I will not exercise the option. And similarly, call option buyer will also not exercise the option. So in this case, the premium, the gain of premium would be happen for me. So again, we can see the net loss is 50,600 in this case.
This is equivalent to the maximum loss you can make in this thing. Okay.
Yeah, this is equivalent to the maximum loss that we can make in the bull call spread strategy.
Well explained. Yeah, wonderful.
And then the third case, in the case 3, let's assume our price is 1495. So we have seen the break even here in the naked call part, it's 1490. If we just go a bit more than that, 1495, again we can see a profit of 4.15 per share and 20,805 for the entire lot. And the gain of premium here, because call option buyer will not exercise the option because 1495 is obviously less than 1510.
Okay.
So again, therein I will get the gain of the premium and my net gain would be 86,900. Now the case 4 is a classic case of spot price at break even. So I have shown you the break even point here under the bull call spread strategy. So this is 1479.2. Now let's see how this plays. So if I take the break even point at 1479.20, we can see there is no gain, no loss. So at this break even point, my loss is this much because obviously I will exercise the option. I will exercise the option and the call option buyer will not exercise the option. So all in all, when we will see that here I have lose 64,000, but here I have gained the 64,000 rupees.
Okay.
So all in all, my net gain and net loss is 0 at break even.
Okay. Okay.
So now let's move to the bear put spread strategy. So again, this is a similar example. 1st March 2024, spot price is 1430.75. The company is same HDFC Bank, and my expiry is also 28 March 2024. So similar is the case, 10 lots, 550 units. So here I have choose the spot price is 1430.75. And my I will what I will do in this situation is at the leg 1 I will buy a put option, in the leg 2 I will write a put option. So in the leg 1 I have bought a put option and the strike price is 1390.
Okay.
So for that I have paid a premium of 15.75. So this is the total premium. And then at the leg 2 I have write a put option wherein my strike price I have chosen is 1340, which is out the money. And and then I have received a premium of 7.4 rupees per share, and this way total premium received is 40,700. So my net premium paid is this much. And what could be the gain, the difference between these two? Right, so this the difference between so this is the maximum 50 gain that I could expect. And so if I multiply this 50 with 5,500, then I get a gain of 2,75,000. And my net gain in this case would be difference of these two. But in this case, my net gain would be lesser because my premium paid is more. So here we can see the maximum loss is 45,925 under this bear put strategy. However, had it been not the strategy, if it would have been naked put, then my loss would have been 86,625.
Yeah.
Now we'll again go to the 4 cases. So obviously in the put option, what exactly we are telling ki I have the right to sell at this strike price, at this 1390. I have the right to sell at this 1390 strike price. So for sure, if the market goes beyond this, lesser than this, somewhere around 1300, then I have a profit of the difference between that two. So in the case 1, I have considered the spot price as 1310. So if I consider the spot price as 1310, so this would be my profit. This is my total profit, and because I will exercise the option. And obviously put option buyer will also exercise the option because the strike price is 1340. He will also exercise the option, and I will have to give the premium of this much to the other party who has bought the call. So my net gain would be 2,29,075 rupees. In the case 2, I am assuming the spot price is greater than 1390. Greater than 1390, which is the strike price is 1390. So if the spot price is greater than 1390, then for sure I will not exercise the option because here I won't gain anything. So in this case, I will let the premium go. My loss of premium would be this. But again, the put option, the put option that I have right, that buyer will also not exercise the option. So that gain of premium would be happen to me. And again we can see the loss is 45,925, which is similar to the maximum loss.
Okay.
So this is the loss that we will incur. In the case 3, I am assuming the spot price is 1368. 1368 and which is below, which is something less than the naked put break even. And we can see here we have a profit of 75,075 rupees. And in the last case, we'll see the break even point as we have calculated the break even point of this pair put spread strategy with the same formula. So bear put spread strategy, we have considered the spot price at that. And in this option, so what would happen in this case? If my 1381 is the price, which is less than this, obviously I will exercise the option. But after exercising option and adjusting the premium, I get a loss of minus 7.40. But put option buyer will not exercise the option because the strike price is 1340. Okay, so in this case my gain of premium would be 7.4 per share because the option buyer has not exercised the rights. So in this case my again net gain is 0.
Okay,
so
very good.
so these are the two strategies that we can apply in the market while performing any trades.
Very,
In the
very wonderful, wonderful. That was a great presentation, and just share me with the Excel sheets also. And I think you have done a great job. So this you also this. I think you have been dealing with stock market, is it? I mean, थोड़ा बहुत आपका exposure रहता है, or you have been just
Yes sir, मेरा exposure है पिछले. Yes sir, I have been in the stock market for the last 4 to 5 years.
5 years. Okay, okay, ठीक है. तो अभी जो हमने आपको पढ़ाया था उससे आपको हेल्प हुआ, मतलब when I
हाँ सर,
ओके
हाँ सर ये ऑप्शंस मुझे उतना ज्यादा क्लियर नहीं था, बट आपके क्लास करने के बाद ये सब स्ट्रेटेजी वगैरह फिर मुझे और क्लियर हुआ.
Okay, now you can, these were the basic strategies. You can just go to there about, I think, 30, 40, 50 strategies or more than that. So you can, if
There
you
are much
understood
more.
one, then you can understand all basically.
Yes sir.
Okay, chalo, good, very good job. Wonderful.
Mm.
Very few
Thank
people, very few students will, go into such kind of a presentation, because it requires a lot of, understanding, and call options are something which is, which are difficult for most of the people, almost like 90% of people in this world. And it's not so easy to explain the options. People can always, stumble, fumble while making presentations regarding these. Okay, so you have done a good job, and you have considered about 4 scenarios to explain. Okay, so that was wonderful. Great job. Very good.
thank
That's
thank you
one.
sir. See,
The best
I'll
one.
share the slides and Excel with you.
Sure, sure. Okay,
Mm.
great.
Thank you sir.
So now we have the third group. Okay, so others can leave. So we have now Anuj, Asta, and Aditya to be there. Okay. So, एक second, मैं just wait for 2 minutes. Okay, I'm just going to close this this recording so that